Okay. So today we have two topics: efficient markets followed by investors' behavior or behavioral finance. The first one would be with the efficient markets. So before I start, what do you feel? The stock markets are efficient? We have NASDAQ, we have New York Stock Exchange, NYSE American, whatever the stock you consider. What do you mean by efficiency? What is your understanding? So that, yeah.
And beat the market according to the efficient market.
Perfect. Yeah.
The
You're right.
ranges are due to like random factors that you can't predict.
Good. Yeah.
Isn't it is constantly reacting to all available data at all times, and it's constantly being updated as well.
Okay. So it is, the information is available to you all. It is updated. Everyone knows about it, right? Anyone else? Are the markets efficient? Okay. There are a lot of debates on this. So once we quickly get into the framework behind that, what the researchers talk about this, then we can conclude in our class whether it is efficient or not. And we can formulate a definition for that by ourselves with our opinions and views. Okay. So today's class with efficient markets, we'll be understanding how security prices changes and why they'll be changing if it is an unpredictable, which we call it as an efficient market. We have some evidence and support which supports and contradicts efficient markets. Both the dimensions, we'll see that. Then we have the interpretations of stock market anomalies. We will be knowing more what is an anomaly, but quickly on that. If the markets are inefficient, anomalies are the reason. That is also interpreted in this class today. Then we also formulate investment strategies that make sense for informationally efficient markets, how to formulate strategies in an efficient market, if it is efficient. So this is the idea for this session, so that all my students will be well connected through these outcomes. Okay. So more than efficient markets, efficient market is more popularly known as efficient market hypothesis, which has its roots linked to random walk and efficient markets. And we'll be discussing more on that. What is random walk to start with, and what are the efficient markets? And what are the, if the markets are efficient, what are the implications? And then we can test whether the markets are efficient or not. And how does mutual funds and analysts react to efficient markets? This efficient market is as old as decades. It started with the 1953, when Kendall gave a random walk hypothesis. It means that stock prices move randomly. There is no pattern. There is no trend. Using time series analysis or technical analysis, you cannot predict the stock prices for the future. That's the idea of Kendall. He gave his research in his paper in 1953, saying that they're random. Then he explains that price changes are completely independent of one another and unpredictable. So what do you mean by independent here? Google stock is up does not mean Nvidia stock will also follow the Google stock or other technology stocks. Each and every stock, irrespective of sector or industry, size, small or big, they are independent. They move based on the available information related to the stock. As simple as that. That's what you mean by independent. Stocks are independent, prices are independent, they move independently. Now we get into efficient market hypothesis. the base for efficient market hypothesis is Kendall's random walk hypothesis. It is based on that. Based on that, in the sense, they take that as a base by saying that stock prices have a random walk. There's no pattern. They move randomly. And to take it further, as our friends were saying in the beginning of the session, markets have all the information. There's nothing new. If something is new, they reflect immediately, instantly on the same day. That's what you mean by a random walk. Yeah.
Like people in Congress, but like information.
We'll come to that. We'll come to that. We'll come to that. We are going at a slow pace, one after the other. We'll be covering everything. I will answer your question then. So, past information which belongs to yesterday, where prices were reflecting the information, has nothing to do with the prices today. That's the idea here. There is a complete disconnect from yesterday's information to today's information. You have to search for new information, buy new information, get new information. That's it. Till then, the stocks are stagnant. So if that is the fact, how the technical chart will look like? Any guess? Say Apple had some news on September 20th or 19th, I don't believe. It went up by 10%. Okay. That day it has to move. From there till now, there is no additional piece of information related to Apple. Then its price should be flat. There should be no volatility if the efficient market exists. Make sense? That's what efficient market says. Then moving on. So he is Eugene Fama, Nobel laureate, a big name, big person. He is the one who dealt finance separately, known for disintegrating finance completely from economics, even from financial economics. His first work was on efficient market hypothesis. He is one of the researchers I admire. I read a lot of his papers. I follow his updates. I had many of his interviews on my laptop for several years. So he's more practical. He is problem oriented. He tries to fix the problem, which is future need for many investors or markets or policymakers. So his major works are, to start with, efficient market hypothesis. Then there is something called joint hypothesis problem, which is everyone criticized CAPM and extended that. And they also criticize that efficient market has a drawback because they say markets are efficient, and the CAPM says its own equilibrium. So these two are different hypotheses, cannot worked out. He worked on that problem also, joint hypothesis problem. And there's something called agency problem. I don't know how many of you are aware of it. Agency problem arises. Quickly, anyone about agency problem? Yeah.
It's when the manager or leader's visions don't align with the company's.
Yeah. So the company is an entity. Owners own the company. They have the control actually, but they're not professionals. They're not qualified. They delegate the control to managers so that these managers work on the interest of the shareholders. But the problem comes when the managers are deviating from shareholders' problems and working on their own problems. For that, the first paper and popular paper was Jensen and Meckling, who said that there are some operating costs and monitoring costs and residual costs because of this agency problem. Then FOMA came forward and said that no, there are no costs at all. If at all there are some deviations from agency, there is an internal and external governance structures which will fix the problem without cost. That's how he was also popular for that. Then he was more popular because of Fama French three-factor model, which we discussed in the last class. You remember? Single index Jensen alpha, when we are calculating those things, we use three-factor model. One is market factor, other one is HMB, other one is SML, small minus large. These three factors put together. So that was a critique of CAPM and extended CAPM with the three factors. So that is a brief introduction about this person, William Sharp. I'm sorry, Eugene Fama. Now we've been talking about efficiency. Efficiency is all about to what extent the market is discounting the available information. Okay. So when you say information, I think this is what you call it as information. Any piece of information related to these areas is reflected on stock prices. If you remember in our third module, when we're talking about equity valuation, we discussed about fundamental analysis, economic analysis, industry analysis, and firm analysis or company analysis. So any information related to this or beyond that, that should be reflected in the stocks. So among them, to start with, corporate actions. What are it is more known as corporate actions. What are these corporate actions?
They might be like decisions that come such as like changing the suppliers or like changing like the material that that's pretty much it. There's this kind of issues that my company made that my wife's going to be quality product.
Right, you're in. That's right. Anyone else would like to try corporate actions? So it's more over corporate information. Corporate information, it could be dividend declaration, new projects the CEO announces to SEC or the stock exchanges. New CEO comes, some CEO retires, resigns, leaves the company. New expenditure, new spendings, anything related to company, which is from the company, from the industry or economy or anything, but related to company, it is corporate action. Moreover, more related to the company. Then economic data, we have seen what kind of economic data is important for stock prices. GDP, tariff, interest rates, inflation, consumer confidence index, business confidence index. There are many. So whatever the piece of we have seen lagging indicators, coincidental indicators, and what else? Leading indicators. These are the three. You have to take care of these three. Then political news is also important. Industry information, sometimes because of a policy framework of the governments, some industries are supported or affected. Okay. I think in the last year, there are a lot of investments, announcements by government on chip technology or whatever. So that boosted all the companies. Again, coming back to tariffs, whatever the industry is protected with these additional tariffs, their stock price will boom because of the protection. And demand and supply shocks, 2008 crisis, pandemic situations, these are the shocks, war situations. And impact of global markets, importantly nowadays, they are very dynamic. It's very important to follow them. So quickly to follow on the corporate actions, I just added some. We are not limited to this list, but these are some of them which you can use. Dividend announcements. This is more important because it is a big puzzle. Dividend has a problem. There are many theories on dividend. Dividend irrelevance theory of Modigliani and Miller, or irrelevance theory, whether the company pays dividend or not, firm value or the share value will remain the same. But there are some people who say, no, dividend is a signal. Dividends are paid by the company to the shareholders, means company is expecting more cash flows in future. Because of that, CEO has the guts to declare the dividends. That's a good news, which lifts the stock price up. Okay, so the dividends are always there to influence the stock price. For example, we have something called in dividend discount models. We have been talking about dividend kings, top five. We're talking about Johnson and Johnson. They are known for paying continuous dividend for more than 50 years. If these kind of companies they stop paying dividends, stock price will come down. If they increase, they will stock price will go up. So usual companies doesn't do that. That's the reason we have something called dividend smoothing, so that markets will not be affected with the dividend decisions. And new projects, new orders or capital expenditures. If American Airlines discloses to the market that we have put an order for maybe 50 Airbuses. That's a big news. It's expanding. More future cash inflows expected. And M&As, importantly, mergers and acquisitions. Whenever acquirer acquires a target company, it is good news for the target. They will benefit more than the acquirer. Keep that in mind in valuations or analyzing whenever there is a news. So I think I thought of sharing markets are closed, but let us try still. I think this is the last one. This is the latest one. This is very general related to company. Do we have any? US reports. Okay. In the trading hours, you will find more of them. How about Yahoo? You can check. Now, in the coming, at the end of this session, I'll be asking all of you to build your own portfolio. I will give you all the guidelines or rubrics or whatever. Don't worry about it. But why I'm telling you that is whatever we have discussed practically, make a note of it. It will be useful for you. There is nothing company specific here. It is all about markets and some recommendations on Jeffries, country relationships. I think there is information on this. Okay. So you can check in the trading time, trading hours, you'll get more. I think this is what I got. I think today afternoon, I think around 1 o'clock, I was working on this. Rare earth miners stock slammed after US Defense Department cancels cobalt purchase. You see that? So this is political or governmental news which has hit this company. Okay. So like that, there are many. Can go through them. Something about Goldman. This is very useful information. Okay. There was a research study on, remember, we are talking about market efficiency. We're still there. This research shows, this is the study on M&A announcements. Okay. So what's happening on the chart here? Can you see the chart and tell me? Can you help me, please? What's happening on the chart? What is on x-axis? What is on y-axis? What does those dotted lines tell you? What's the horizontal line? What is the vertical line? Yeah.
Once the company is acquired, they significantly better in terms.
Okay. The returns have gone up.
Yeah.
Okay. Yeah.
Company announced. Well, on the x-axis, the merger wasn't announced, and the day it was just announced, they were having earnings up to like 30. It's 30 years now, something like that.
Yeah. Okay. Okay. This is the day, event day, we can call it as in research. Mostly researchers do difference in difference analysis. what happened after the event, before the event and after the event. So this is the event day, and these are 30 days after the event, and these are many days before the event. Event here is acquisition. Company acquiring another company. So as I told you already, it is the target company which gets benefited more than the acquiring company in a M&A activity. So what this picture tells you here is, when the announcement was done here, the price was hovering somewhere here around. Remember, we are not charting the price. It is actually cumulative abnormal return. Okay, you can see that from here to here, cumulative abnormal return is less than 0, which means negative. What is abnormal return, by the way? Abnormal return. Okay, if we can, we have seen that in the earlier class, your stock return or the actual return minus required rate of return or expected return. Okay, we have seen the case, we use the word alpha also regarding that. Your portfolio return minus the required rate of return based on CAPM model. Risk-free return plus beta times market premium. That is what you called as abnormal return. So cumulative abnormal return is negative till here. It started increasing from here to here. How do you interpret this? Till here, it is negative, but it has become positive. 20, I think close to 20 days, something like 20 days. Yeah. Exactly. That's what I was looking for. Maybe the target companies, managers or shareholders or board of directors, maybe they know that this is going to happen. They started buying the shares. Maybe from the acquiring company, someone is aware of it, acquiring the shares of target company. That's the reason this is happening. If not, it will be absolutely 90 degrees. The market is efficient. So this is the work done by Keown and Pinkerton in 1981, proving that there are some inefficiencies. Once officially it is done, it is almost stable. Around 25% maybe. Okay. I think one more study by Buss and Green in 2002, they have taken 12 February midday call segment. CNBC used to have a midday call segment, but they call it as halftime report now. The name got changed. They have morning calls and midday calls. So the panelists will come, analysts or whoever are the experts, they'll be talking about the news on the day and how it is good or bad to some companies and industries. That will make the stock prices volatile related to this information. So these two did a beautiful research and gave this image for us. So again, cumulative returns on the y-axis you have, and again, you have the movements here. So what do you think? What do you get from this chart? Is this useful for us? Okay. No, what is it? We don't know. Even the authors also can't remember that. But looking at the chart, how can we interpret? Okay, let me say that. You see this, all the positive information stocks are here. Positive information means the stocks which got positive reaction to the information on the call, midday call. Okay. So again, you can see here, this is the event day, say 12 o'clock, 12 p.m. exactly. So what happened before 5 minutes and before 10 minutes? Okay. So I think before till 10 minutes, it's flat, damn flat. You can see that. But I think before 5 minutes, I think there was a movement here till here. And from here, it started going up. Same is the case with negative stocks. It's almost flat till here, but flat here also. This is about negative abnormal stocks. But post announcements, this is almost flat. There is no much change. But the negative reacting stocks, they were flat till a point, but they dipped down further, even after 10 minutes. So there is a differentiation between positive news and negative news, making the market respond differently. This is again a problem. If the markets have to react, they can react in the same way for both positive and negative. But for negative, it is different compared to positive. Okay, so as some of us are saying, we all look for information and we compete to grab the information from any source, public or private or institutional or paid or free or open source, whatever you call it as. I love to have the information related to any stock if I'm an active investor. Okay. Even if I'm not investing, if I have a portfolio of you all investing in with me, I need to take care of your money and look for information. Mutual fund does that. So this competition among the investor indicates that price, whatever the price is there of a stock, that is discounted with the information. Then investors exploit available profit opportunities based on the information instantly. And there exists competitive advantage, which can verge on insider trading. I think this is an exemption. Public information, paid information, yeah, it's known. But insider trading happens with private information. That may happen only with one person who is a CEO. She's a CEO of a company. She has the information. She may ask someone else to buy the stocks, family members, friends, or relatives, whatever. There is an opportunity. So competition is important among the investors to discount the information and get the prices reflected. That's how the markets become efficient. Now coming to the real picture of efficient market hypothesis. Straight away, we're talking about the market efficient or not. We cannot say like that because within the efficiency, we have three forms. Okay. Weak form of efficiency, semi-strong form of efficiency, and strong form of efficiency. We have these three forms. So to justify the deviations, we have seen some gaps, right, in the charts. We have to justify these differences or deviations. These categories will help. Okay. So to quickly on these kind of categories given by Eugene Fama in his efficient market hypothesis, weak form is the stock prices, means the stocks which are traded in the stock markets, their prices, they already reflected fully the available information. Okay. So if you try to get the data of a stock of Apple, for example, for the past 1 week or 1 month or 1 year, and you try to build a chart, it doesn't help you. Okay. Why? Because the whole information is already reflected in the stock price. Then semi-strong form. In the weak form, they talk about historic information. In semi-strong form, the new information which is publicly available till today is already discounted. So in the weak form, you can't do technical analysis or you can't use technical analysis to make more money than others. In the semi-strong form, I think we have spent a lot of time on understanding fundamental analysis to make money, right? But Semi-strong form of hypothesis says that you can't make money if the market is in semi-strong form, even if you do fundamental analysis. You can't make money out of it. And finally, strong form, even the insider information cannot make money. An insider trader cannot make money. They say that it is known to everyone. So these three are the basic categories of market efficiency. The beauty of this is, like CAPM, there are additional models with the 2-model, 3-model, and the 4-factor models. But efficient market hypothesis remains the same. The additional work was on anomalies we'll be talking today right now, but it is still holding good. So these are the 3 forms. Now, to practically look at the market efficiency, to test market efficiency, a lot of research was done on efficient market hypothesis to test it. So when we say technical analysis, we are talking about which form of market? We have seen these 3. These are the 3 forms of the market. When we are talking about technical analysis, which form you're talking about? What my question? I repeat. I'm saying there is a lot of research done on technical analysis to know whether markets are efficient or not. Okay. So in that case, which form we are talking about when we are saying we're testing technical analysis? Is that weak form, semi-strong form, or strong form? What do you think? Okay, it is the weak form. Technical analysis is related to weak form. Okay, fundamental analysis is related to semi-strong form. Strong form is related to insider trading. Keep that in mind. These 3 are completely different. When we talk about the research, testing market efficiency, they should fall in one of these 3 categories. Okay, so technical analysis is testing what? Weak form. Fundamental analysis is semi-strong form. Okay, we see all this in order, one after the other. Starting with the technical analysis, there are a lot of things. Maybe sometime I will try to talk more on that. We don't have technical analysis in our modules, but I try to give more. Any one of you follow technical analysis, by the way? Did you follow? Did you do? Or did you simply took the advice of any analyst who is saying this is the price you can buy, this is the price you can sell? Okay. So a lot of chartists, they'll be advising you. They don't know fundamentals. They don't talk about fundamentals. It's not they don't know. Technical analysis doesn't talk about fundamentals because they're looking at historical prices. Got it? So they don't care what's happening. They just look at the charts and tell you this is the support, this is the resistance. So what do you think resistance level is and what is support level is? Can you quickly find out if any analyst has given type for support price of some stock of your favorite, which is your favorite, or resistance level of Palantir or Nvidia or Tesla or any stock, Walmart? Support price, resistance price, support level, resistance level. Any stock will do. You can find, or you can say S&P. S&P is also dictated with support and resistance. Yeah. Anything, just you put it in. By the way, which AI you guys are using? Which one you're using? Most of you? Is it ChatGPT or anything else? Anyone else using apart from ChatGPT? Sorry? Perplexity? Copilot? Yeah. And because I was experiencing a Perplexity, it was amazing. It was so quick, super fast. And it has a lot of features. In the free version or the paid version, it was so good. I thought of sharing that with you for the past many weeks. I was forgetting. Today, I could recall today. Try Perplexity if you wish to. Yeah. Could any one of you get? You just try support or resistance level of your own stock. That it be Tesla or S&P. Can you do it for me? Support level or support price or support of something. It could be S&P 500, Google, Nvidia, Walmart, Publix. Couldn't get anything. Just to make that connected to all of us. Yeah.
For example, be like in 300.
Now, how much is the support?
Just up. Yeah, okay.
Give me one. Give me one. How much is the support?
Really?
308. Okay. Do you have a resistance for the same? 440? Oh. Okay. So we got some piece of information from a technical chartist or analyst advising that Tesla, that is Tesla, right? That's Tesla, right?
Yeah.
So that says that Tesla will move between 308 and 440. It will not fall below 308 because it has a strong support at the bottom and it cannot go beyond 440. So same is the case if you tomorrow when the market opens, I think you will get more information on that. Try to get the support and resistance for all your interested stocks. That will be quite interesting. Then in fundamental analysis, as we discussed, we have economic analysis, industry, and firm analysis. So related to company, you'll be having a lot of information, importantly with their earnings, how frequently the earnings are announced by companies. Any quarter, every quarter. Every quarter, the companies do announce their results. The gross profit, their EPS, are they paying dividends or not? Everything is known to the public. So every quarter means at the end of the first quarter, April is the month for announcements. Stock market will be little volatile. Again, July, again, October, and again, Jan. These months will be little volatile because of the announcements. Then, so the fundamental analyst will be more interested in knowing the future values to discount them based on the earnings announcements. Then how do passive investment strategies and index funds work with announcements? So we already discussed that in the previous session. We also seen single index models. When we are talking about multi-factor models in CAPM, we exemplified with these funds. We have seen ETFs. Now we have index fund and passive investment strategies. So buying well-diversified portfolio without attempting to find mispriced securities. So that happens with the closed-ended funds. Moreover, maybe they just buy not closed-ended funds. Anyone can do that. Passive investment strategy is like a mechanical investment strategy. I will ask you in your own portfolio simulation, that one also. If I ask you to pick up a stock, How do you do that? How do you select? Based on our discussions till now, we have P's, we have book values, we have dividend discount model, we have market PE, market to book. There are many parameters. In that way, some of you believe some methods. So with that, what you do is you say, give me, maybe you tell your own AI, give me the stocks where their PE is less than 10 in so and so sector. You'll get a long list and you build a portfolio on that. That's almost like passive investment strategy. Got the idea? So when the PEs are high, you strongly believe in PEs. Low PEs means they are more fundamental. That's your belief system. Historically, you made money out of it. So that works. Similarly, index fund passive strategy is also has index fund as a better example. They hold the portions in index fund. We have seen in the last class. Within index fund, we also may have different strategies. I'm talking about ETFs, passive, threshold, and active also to give more returns for the investors. Then in these funds, when passive management goes that way, how does active management will look like compared to passive management? So active management assumes market inefficiency. So when I said passive, I think you all are aware, right? Difference between passive and active. How do you differentiate these two? Active portfolio management, passive portfolio management. So we have these two examples for index fund is one example where it has a passive portfolio management. And the other way, active portfolio management. And in the mutual fund session, we have seen that active funds have high expense ratios. Passive funds have low expense ratios because they don't put that much efforts. But active put more efforts. My question to you is, when portfolio managers are putting more efforts to make more money for you, what's the basic difference between active and passive? That's my question. What do you think? Yeah. Exactly. Right. Stop there. I have another question for you. In the view of market efficiency, taking your view to the next level, in the light of efficiency, market efficiency, how do you differentiate these two, active and passive? Okay, let me put the question the other way. Who believes market is efficient, active or passive? Market is efficient. Who believes that? So passive portfolio managers, they believe market is efficient. It's waste of time to put more efforts on managing the portfolio. That's passive. Active managers, they try to beat the market because there is something missing we need to find through research. Thanks for that. So that's what the implications of EMH, efficient market hypothesis apply to active and passive portfolio managers. So again, inefficient market pricing leads to inefficient resource allocation also. Not just pricing, it hits the resource allocation also, market rates. I think we have important research done based on the market efficiencies. We'll be looking one after the other quickly. So first we'll be dealing with what are the issues related to the efficient markets. Then we have discussions and tests on weak form, then semi-strong, then strong, then conclusions. This is how I composed for you and have a close look into it along with me. To start with, we say market is efficient. Market is not efficient, but that is a wrong way of giving our comments. What does that mean? Research says that it is not binary. It is not that yes or no. It is relative. It is efficient to the maximum extent. It is efficient to some extent. Relatively, you have to say that. That's what the research says. Then the other issue is investors' bias, where whenever investors who find successful investment schemes, they're less inclined to share findings. So unlike a portfolio manager who has a huge investment to dictate the market and increase the volatility of the price of the stock, a retail investor like you and me, though we have some important information in mind and grabbed a beautiful strategy or model to make money, I think we don't share that with others. So what does it mean? It means you're making money, but it is not known to market. So market is not disturbed, but you are making money out of it. It could be a kind of idiosyncratic risk where you're making return. The lucky event issue, they have a disproportionate attention. It's like gone with the wind. You windward. You are making money not because of your efforts, but along with the market or because of something else, which is labeled as luck. Okay. The first form of test for us today is the weak form. What did they do? They worked on the patterns in historical stocks, like the technical charts. So there is you need not remember the names of the authors. I'm just giving the concepts, but for my interest, my favorite area is investments. I'm more into investments research. So I was just linking all those authors to the respective concepts or works they have done. So Jagdish and Titman, what these found out is they had something called momentum effect. So what is this momentum effect? If there is a positive news, that is not completely discounted for a single day. It goes on for a few days or weeks. That's what you call it as momentum. So by that, you might have also gone through momentum stocks. So growth stocks, cyclical stocks, defensive stocks, if you remember. So growth stocks, cyclical, they are more of momentum, but not defensive stocks. So when there is a piece of information related to those stocks, you have more momentum for a long period. So that's what momentum effect was observed by Jagdish and Titman with the research published in 1993. Then Fama and French, not only these two, Poterba and Summers, both in same year, 1988, they had something else as an extension of Jagdish and Titman. What they say is, okay, for the short term, there is a momentum. They're moving up. But in the long term, they have a reversal effect. Whatever goes up has to come down. Whatever goes down has to come up, kind of thing. So which means it has to meet the valuations. So reversal effect is also discovered by Fuma. We all again got Fuma. I think this is a wonderful work out of research of Robert Schiller. This is the work done from 1871. Do you believe that? Yes, they did it. From 1871, what they did is the dark line, this one, the black one, is the actual value line. That is the potential a stock price has. Okay. But look at the red line. It is oscillating above that and below that. See, from here to here, it went up till here and came down here. And as Fama was saying, reversal effect. You could see the reversal effect here. From here to here, it was the momentum effect, as Jagdish and Titman were saying. That was momentum upward. And again, downward here, upward here. I think this is again upward momentum. Okay. They also extended by including a terminal value of 30 years dividend growth, dotted red line. So this picture tells us that yes, momentum is there, which is a deviation from market efficiency for a time for the momentum period. So maybe analysts try to grab momentum stocks. They advise you. Keep an eye on momentum stocks. Whenever there is an information, they continue to go up or continue to fall down. Can you make money if the stock is falling down? Yeah, you take a short position or buy a put option. Like we'll be having more on put options in the last session, but quickly on that. So that's about a test of weak form of market efficiency, where we have momentum effect and reversal or mean reversal. Then okay. Then further, we have more on this by Foma, Campbell and Schiller, Stamberg, Foma and French, all in the mid 80s to late 80s. So what do they say is, I think Foma and French already said that there will be a mean reversal, though short-term momentum is there. So what Foma French says, return on aggregate stock market tends to be higher when dividend yield is low. So what do you mean by dividend yield and low dividend yield? You remember we have been touching that many times, 3 or 4 times we had on the screen sessions also. What do you mean by dividend yield? Dividend yield. You remember the formula in calculating returns? We calculated dividend yield. Dividends divided by buy price. Dividend yield, total holding period yield, and capital gain yield we have seen. Okay. So what it says is, Foma and French, what they say is, aggregate stock market tends to be higher when dividend yield is low. When dividend yield is low means what? The price are going up. That's how the yield will come down. It means that you're getting the dividends, even the capital gains. That is good. Okay. If you want more money, there's something called a homemade dividend. If the company is not paying you the dividend, you can pay. You can get cash in hand by selling some part of your own stock. That you call as a homemade dividend. Then they say that Campbell and Schiller say that earning yield can predict market returns. So when earning yield means EPS, DPS by market price is dividend yield. Earnings per share, EPS divided by market price per share is earnings yield. So earnings yield is increasing. Then what's happening to market price? Dividend yield is coming down. What's happening to market price? Dividend yield is coming down because market price is going up. Denominator is increasing. So the answer is coming down. Because denominator market price is increasing. Similarly, earnings yield. When earnings yields are coming down means market price is going up. So Campbell and Schiller, they say earnings yield is useful to predict market returns as well. Then Keem and Stomberg, they used bond market data, and they said that spread between the yields. We have seen the spreads, if you remember. we have the yields difference between investment graded bonds and non-investment graded bonds. That's the junk bonds, we call them as. The higher the yield, what happens? The yield is increasing. So when the non-investment grade yields are going up, means people are putting more money there. Maybe it's not good for the markets. Then again, from a French in 1989, he gave something on risk premium. They said that they talked about yield spread between low grade bonds and high grade bonds. They have the predictive power of returns on low grade bonds than high grade bonds. So it is more useful for low grade bonds, that is non-investment grade bonds or junk bonds. And not only that, they have the predictive power for stock rather than the bond returns. Then dividend yield on stock helps to predict bond market returns. It suggests that yield captures a risk premium common to both markets. Both market means bond market as well as equity market, than mispricing the equity market. So we can have predictors using the yields, dividend yields, earnings yields, and yield spreads in the bond market. That is what this research tells us. Then further semi-strong tests. This is about a weak form of market efficiency. Now we have semi-strong form of efficiency. They call it as they are deviated, but that is because of anomalies. When you say anomalies, there are many, but more of the research now which we discuss is more about investors related. We have calendar anomalies, we have firm characteristic anomalies, and so on. So let us see what they are. So to start with, Basu in 77 and 83, in both the years, what he said is low PE stocks portfolio have higher risk adjusted returns than high PE stocks. See the difference. So low PE means price to earnings, market price per share divided by earnings per share. Low PE means the answer we are comparing. Low PE, what do you mean by low PE here? PE is low, PE is high. What does that mean? Price divided by EPS. Answer is low, answer is high. What does that mean? Yes? Yeah.
High price. Higher.
You're saying P is higher?
Yeah, it's higher.
Yes.
Probably.
A simple relationship. Market price on the numerator, EPS on the denominator. The market price is high, P is high. Or EPS is low, P is high. One of these two should happen. EPS is falling, market price is stable, P is high. Or else EPS is the same, market price is increasing, P is increasing. So that's the relationship. This study shows low PE stocks. So low PE stocks means it could be higher EPS or low market price. Because of that reason, PE is low. That makes PE low. Then small firm effect. This was interesting. I think till 80s there is no much debate on small stocks. But with the Pharma Friends 3-factor model, we had HMB and SML, where they have introduced small and high. by dividing the research, the whole study into either 5 quintiles or 10 deciles, and getting the difference between the 10th one and the first one. That changed the whole research platforms on investments in finance. That was a good model which was introduced. So, small firm effect, what it says is stocks of small firms can earn abnormal returns primarily in January. So abnormal returns, I think sometime I was saying in the class, it's a good idea to buy small stocks in the month of December, late December. They give good returns in the month of January. It was historically proven, not sentiment or supportive view on small stocks. Then there is something on a neglected firm effect. Their potential but not known to the market, but they have huge potential to give abnormal returns. So that was found by Herbal and Distribble in 1983. Again, they earn higher equilibrium returns as compensation for risk associated with limited information. So higher the risk, higher the expected return. They do that. They fulfill that. Merton in 1987 gave the evidence on that. And finally, on this semi-strong, which is a market anomaly, less liquid stocks. We don't know whether it is small or big. Usually small, the stock is less liquid means. So they also have the potential and to make more money, because that could be related to either small firm or neglected firm, and they always give premiums as the investors demand that. Okay. I think I used to have this kind of a strategy. I lost to some extent, but many stocks gave good returns. But these kind of stocks, just buy and forget it, like Warren Buffett says. Feel that market doesn't exist. Market is closed. Once you buy the stock, that helps a lot. If you strongly believe that stock, buy that. So that's what about small stocks and neglected stocks. But the major risk is liquidity. If you need money, you can sell it. Bid-ask spread is so wide. Maybe $50 is the ask price, $90 is the sell price. Maybe the market permits. That is huge. So these are the anomalies. PE, high PE, low PE, small firm, big firm, neglected effect, and less liquidity. Again, extension on market anomalies with the semi-strong firms. Book to market. Again, like PE ratios, we have high book to market firms generate more abnormal returns. So what is book to market here? Book value per share, BPS by market value per share. BPS by MPS, or book value by market price, will give you that ratio. So what the research says, shares of high book to market firms can generate abnormal returns. So high book to market firm means book value is high or market value is low. That's the reason ratio is high. Then post earnings, when the response is sluggish, I think this doesn't happen to S&P 500 stocks or blue chip stocks, blue chip companies. But it again, it goes to neglected stocks or small stocks. They discount information slowly because markets doesn't believe, first of all. You got the information related to unknown company. Is that real, true, practical, feasible? They question everything till the time it keeps on creeping slowly. It doesn't jump like index stocks. Then abnormal announcement days. When there is announcement day, momentum continues. I think we already seen this. It is a repetition here. And some more on this, even the market is not moving, there should be some specific company related information making the price volatile. You will see sometimes market is so stable, looking good, but one stock has reached the upper limit. It is going up. It is in the top 3 stocks. It is a top stock in terms of number of shares traded. value, prices, it has hit the upper circuit. Then accruals and earnings quality, it's very important that it's more of accounting issue. It is important to know that when a firm says sales, how much was cash sales and how much was credit sales, how much of the credit was incorporated into the sales. Similarly, they will be realizing through their own credit sales how that is incorporated into real sales. And then high growth, because that's the reason we have some mandatory disclosures that has to be given to the market or the SEC filings. And high growth firms will have low future returns because they're already doing a lot of vibe in the market. Gross profitability will have high returns in adding back some expenses like R&D in investments. This is something interesting. Some company shows expenses, which is again related to R&D, advertisements, and so on. But when you add back to the gross profitability, the profits go up. That makes the difference. Tobin's Q is so popular in valuing a company. People look at Tobin's Q. This was found that it is a good predictor of average stock return if you know Tobin's Q. So what is Tobin's Q? It's a ratio of present value of investment to its cost. As simple as that. So we have seen weak form of efficiency, semi-strong form of efficiency, and finally, in the efficient market hypothesis, we are seeing the last form, that is strong form of efficiency. Okay. We have, I think, weak form of efficiency is related to what? Weak form of efficiency is related to what? It is related to historic information and it is related to technical analysis. Okay. Semi-strong form of efficiency is related to what? Public information and fundamental analysis. Okay. And finally, efficient form of market is related to insider trading. There's no public information. What is left out? Insider information only. So related to this, by the way, what is an insider trade? Yeah, so who is that you? Yes. So it could be a manager or it could be a board of director or any executive who has a piece of information, trades on the stock. What do you mean by trading on the stock? Buying the additional stock of the same company where he works or she works on the day, number one. Not only that, employees have stock options. They have their own stocks. They sell their own stocks based on the internal information. That is the other way of looking at it. Okay. And remember, all the insiders have to report or disclose their insider trades to SEC. It's mandatory. If someone finds that there is a relationship between the stock price volatility before it came public and the trades of this executive, that person is in trouble. It's not that easy. So that's the reason they find their own ways. That's a different story. Family members, relatives, or known people, whatever. There are ways, but it's not that easy when you have a strong regulation. So there are some research works done on this. Yeah, they could see that stock price rise to after insiders intensively bought shares and to fall after sales. Okay. That is the research work on that. And another work says that insider transaction would be to no avail. I mean, it's not that easy to get the information from the internal sources, and again to make a trade using that information, because it should be public. One is not authorized to do that. So abnormal returns were not large to overcome the transaction costs. Some other research says that you can make some money, but it's very little. It's not even to meet the transaction cost. Maybe 1%, 2%, 3%. So this is what I was talking about, the deciles. If you look at the chart, do you get anything from this? I don't get anything from this. Do you? It says average annual return for 10 size-based portfolios from 1926 to 1922. They did that. And what is shown on x-axis? Size. So this is the small size, small decile, and this is the large one, number 10. So all the investment researchers, they do this. Quartile or quintile or decile. They find out, divide that, and they get the difference between this and this, which is very important. There is no much difference between these two extremes. I think all are good. If there is huge difference, there's something going wrong. Okay. So I think the chart shows the same. The small firms, small stocks have 17.9%, and the large stocks have 11.2. What's the difference? That is huge. 18 minus 11. 7% approximately is the difference between these two. So if the markets are efficient, irrespective of size, they should have the same return. But size is making the difference. Then same is the case for the book to market ratio. This is based on the size, okay? Size of the firm. So book to market ratio, low is this, high is this. So again, what's the difference between the two extremes? How much? Sorry? 5.2. 16.5 minus 11.3. Again, there's a huge difference. In terms of size, we had close to 7%. In terms of book to market ratio, we had around 5%. Again, there is a difference, speaking some inefficiency. Okay. And one more chart. Let's look at the screen. Let's try to understand. What this could be. This is, the title says cumulative abnormal returns after earnings announcements. Okay. So this is the starting point. This is the day earnings are announced. Okay. Don't assume that all the earnings are announced on the same day. Whenever the earnings are announced, that was plotted as 0. That's the idea. So this is the study of Rendelman et al. In 1982. What do you think? Again, we have the earnings surprises here. We have 10 deciles. For all these charts, we have 10 deciles. This is the first decile. This is the 10th decile. What do you think is the difference between the first decile and 10th decile? There are more earnings surprises, means this cumulative average excess return is high in the 10th decile. In the first decile, it is low, not low, negative actually. You can see these are the days, these are the returns. This is from here to here, it is negative, this is positive. Okay. So I think both moved in the same direction. I think except these two, 9th and 10th decile had higher abnormal or excessive returns, and these two. Apart from that, they're okay. And if you look at these 4, 5, 6, 7, they're almost flat from this day. This is again a research. So the deciles makes the difference. So when we have this much of research done on so many areas based on the deciles, using the sizes, book to market ratios, abnormal returns, or excess returns, what we can see is, I think when this work was done, Fama has to answer this question, right? He is the one who gave efficient market. Okay, what does he say? He attributes this to risk premiums. Whatever the deviation is found out in the markets as anomalies, he manifests that as a risk premium related to that market or that stock. And again, but Lekonishuk, et al., they say that no, this is the evidence that markets are inefficient. They go against FOMA, saying markets are inefficient. So whatever it is, there was huge data with the research on market anomalies. Importantly, small form effect, book to market effect, and it has become a factor zoo. There are many factors with a lot of data showing security returns and risk premium. Okay, so this is the concluding remarks on interpreting anomalies. But if you again, no, we have something else. Oh, again, style portfolio is also used as a predictor of GDP growth rate. Someone is replicating GDP before it really is announced. Again, GDP numbers are given every quarter. We discussed that in our economic and industry analysis. Okay. So in different countries, past year returns are given on the y-axis for the different countries. So the blue is HML and the red or orange, whatever you see as, is SMB. SMB means small firm minus big firm returns. HML means high book to market ratio minus low book to market ratio. Okay, so I think there are deviations here. I think for this, for Australia, Canada, Japan, of course, for Netherlands, it is the other way. So they had different directions for HML and SMB, but for France, Germany, Italy, Switzerland, UK, and US, they are going in one direction. That is the reason FOMA French three-factor model is so popular. They are going in one direction as one of the three important factors influencing the required rate of return. Again, some other way of interpreting the anomalies, McLean and Pontic, they say that their anomalies are there, but they will decline significantly over time. I think FOMA French already told that, mean reversal. I think this was the latest one in 2016. FOMA French was in 90s. Then investor and arbitrageurs exploit them, moving prices closer to fair value and increasing market efficiency. It is a positive thing. Then, but still they persist. If arbitrage is difficult. If there is a misinformation, there is always an arbitrage opportunity. So you remember in the last class we had arbitrage pricing theory. What is arbitrage?
It's quote a price traveling from.
How do you do that?
You give a lower price, knowing it's gonna trade up.
Okay. So buying, so how do you do that? You're talking about one stock or more stocks?
I think it's
One stock. That's my question actually. So same stock, same market, same time. But it is $80 in one market, maybe $85 in another market. That is a great arbitrage opportunity. So sell for 85 and buy for 80. It's free money, right? You get instant money. That's what you call as arbitrage opportunity. So that you can do for small stocks, but definitely not for index stocks. It's quite rare, very rare. By the time you try to put an order, that gets settled. They're so fast, they're quick. So extending this further, so Hyman and Minsky, they say that bubbles are also deviations. I think dot-com bubble, we have seen Alan Greenspan was saying about that many times. It is overheated, overpriced, and it came down to reality in 2003. Okay, but they say that bubbles arise naturally. No one does it. That makes the prices above the intrinsic value, but it is difficult to take advantage of them. Everyone says this is a bubble if it blew out. It is very easy to say that. But when we are passing through that, can we say that? There was a popular strategy by any analyst say that buy at low, sell at high, right? But when is low, when is high? How do we know that? If I know that I'm the billionaire in a day, we never know that. Finding it out is a great challenge. So finally, on mutual funds, how they use efficiency, more on stock market analysts and mutual fund managers. So analysts are overly positive about firm prospects, positive changes with a 5% increase, and negative with 11% decrease. They are different. Low for positive and high for negative. And another study says that level of consensus is inconsistent predictor of future performance. Okay, I think there is a, when I showed you this chart, okay, we arrived at the real value of this. Okay, but it is not that easy to arrive at the values. They use all the dividend discount models and so on. So similarly, when you say the mutual funds are making money, how do they make money? And how the analysts are giving the advices. So what this study says is the consensus is inconsistent predictor with future performance. Maybe then why are they giving the analysis? Giving the analysis and giving the advice. And interesting thing is, firms with most favorable recommendations outperform with the least favorable recommendation. So there is a difference between these two. That was a finding here with an evidence. That was about the analysts. Then mutual fund managers. I think this is a FOMO factor plus momentum. I think a 4-factor model we can say. What are the 3 factors, by the way? FOMO French 3 factors: RMB, market return, then HMB, HML, and SMB. Along with that, this momentum factor is also added, which is more popular, used by mutual fund managers to arrive at required rate of return. Then Wormers, they say that they have positive gross alphas. So mutual funds are making alphas, means they're beating the market. So what does it implicate? Markets are efficient or inefficient? Fund manager is making money, beating the market. Inefficient. That's what the study said. But it is negative when we add the fees back. Okay, it's very difficult how to take that. Manager has done his job, okay, to beat the market. But when we add expense ratios or the fee for this, I think it is negative. That's the alpha is negative. Again, there are some other studies by Carhart. Performance is good or large, but it is due to expense and transaction costs with minor persistence. And Burke and Green, what they say is they keep on performing well to attract the new funds until the additional costs, and this drives to alphas to zero. So till the time they have the more inflows, they keep on performing well, positive alphas and so on. But later on, it will be zero. That's what Burke and Green says. Then another study says that mutual funds outperform bond indexes, gross returns, but underperform once fee is subtracted. I think the same what Wormus told us. Then again, stock pricing ability of minority of managers, sufficient to cover costs, but performance persists over time. And finally, Samuelson says, records of most managers show no easy strategies for success. It's not that easy. That's the reason they're paid high. Portfolio managers' compensation is so high because of this reason. It's not that easy to beat the market. They are paid in a percentage of the portfolio. The reason? To beat the market. Some analysis on distribution of mutual fund alphas with the 4-factor model. So they doesn't outperform their style matched benchmarks. Positive gross alphas, but negate after the fees. I think it is a repetition. This is a kind of normal distribution. You can see that we are here. There's no skewness. It is a normal distribution. And again, one more chart on persistence concentrated at the two extremes. We have the first one, we have the last one. What this is, small group of exceptional managers outperform a passive strategy. That's very little. So you can see that only this and this, they could do much better than others, but rest of them are hovering around zero, less than 0.4%. We're talking about excess returns, not mutual fund, actual total returns. With the final one, when you look at the risk-adjusted performance in the ranking quarter and the following quarter, the alphas within each of the deciles in the base period have the steepness reflecting the considerable dispersion in performance in the ranking period. I'm talking about the red line. And this line is the average performance of the funds. And the shallowness of these lines speaks about original performance differential as they disappear. I think that's it from the efficient markets. So finally, what is your take? Markets are efficient or not efficient? The first question is repeated again. What do you think? I see you feel they're not efficient. I see that. Anyone else? What do you think? Markets we are seeing. Yeah. You take any example or reference. Efficient? Okay. So we can say they're efficient, but little deviations are always there. Okay, but they drive towards the efficiency. Till the time we have superior information, they're efficient. And professional managers' margin of superiority is likely slightly low, or they do that for statistical significance. Superior information always have an edge over others to make more money and pick up more stocks. Then margin of superiority of any professional manager can add is so slight that statistician will not easily be able to detect it. So even if you say I did well, statisticians will say how significant is your performance. So that is all about market efficiency in the first part of our today's module. Any question on this? We'll have a break and come back and continue our discussions with behavioral finance. Thank you.